Hello, my name is Halisha, and before I get started, the workshop is made possible through GNJ Family Life Center's partnership with HSBC Bank and the Center for Neighborhood Enterprise. GNJ's goal today is to equip you for life, so we put together an informative 30-minute presentation on managing your mortgage. It is divided into 3 10-minute sessions. Once you complete the first 10-minute session, please click on the link above to view the next 2 sessions. You will notice at the end of the last session information on how the first 50 people, Las Vegas residents only, who complete the online survey will receive a cash incentive. The last session will also include the website address where you can access the online survey, as well as G&J's telephone number if you have questions regarding the incentive or comments regarding the online presentation. We thank you for watching and look forward to hearing from you soon. So today we're going to talk about what you should know about managing your mortgage, such as the benefits of homeownership, the cost of homeownership, and what to do if challenges arise. Before we begin, it's important to note this content is provided as educational material only and is not intended to solicit you for any product or service. These materials are not a recommendation by HSBC Bank for any product, service, or financial strategy. The suggestions and recommendations contained within are general in nature and may or may not apply to your particular circumstances. Securities, annuities, and insurance products are not FDIC insured or insured by any federal government agency of the United States. They're subject to investment risks, including possible loss of principal invested. All decisions regarding the tax implications of your investment should be made in connection with your independent tax advisor. And should you need further assistance, HSBC strongly recommends contacting an independent attorney, tax professional, or financial consultant. Now let's look at the benefits of homeownership. There are many benefits of owning a home. Homeownership is sometimes used when describing the American dream, and it can also provide a sense of stability. Homeownership can also be a smart financial move. It can be a path to wealth creation. Your home is an investment, and depending on your mortgage product, your ownership may increase with each mortgage payment as you pay down your principal balance. This is called building equity. Additionally, if your home appreciates in value along with you paying down your mortgage, you can build more equity, or the portion of your home's value you own, helping to increase wealth and build assets. With on-time mortgage payments, you can also strengthen your credit history, which can help you get those additional loans in the future. Homeownership can also be provide tax advantages, since mortgage interest and property taxes may be tax deductible, so be sure to consult your tax advisor. A home can be a center of family tradition and also allows you to feel or become a part of a community. Your home is also something you can pass along to your heirs. Let's look a little closer at the potential financial benefits of homeownership. Here is data from the Federal Reserve Board Survey of Consumer Finances. The part where the arrow is pointing in the middle contains the median average of U.S. household incomes of approximately $30,000 to $49,000 for the year 2006. Using this as an example, an average homeowner making approximately $48,000 has a net worth of about $126,000, while a renter making the same amount has a net worth of about $10,000. As you can see, at every income level, the net worth of homeowners is much greater than the net worth of renters. It's important to understand that the net worth of homeowners is higher because the equity in their home. How much their home is worth minus what they owe on it is included in calculating the net worth. Additionally, many people save money for a down payment on their home, and this, quote, forced savings benefits homeowners because as soon as they close on their home, they have some equity already established in this new asset. So let's briefly review the steps you likely took in order to become a homeowner. Buying a home is a big decision, and typically, before you start looking for your house, you first needed to organize your finances, meaning reviewed your income and expenses to help estimate how much you could afford. And since one factor the lenders consider is your past use of credit, you perhaps also reviewed your credit report and credit scores and corrected any mistakes that you may have had on your report. Or maybe you also took steps to raise your credit score by paying all your bills on time and paying down that balance you owed. At this stage, perhaps you even had a lender pre-qualify you for an estimate on how much you could afford, which is different than getting pre-approved. For that process usually involves fees and a more formal commitment for a specific loan amount. And then next, you applied for the mortgage loan. Within this step, you had to find a lender to determine the type of mortgage product that best suited you. With this information, you were able to get pre-approved or pre-qualified and start the house hunting process. And once you found the house you wanted, you made an offer to the seller. And once that seller accepted your offer, you then scheduled that home inspection. And depending on the outcome of the inspection, you may have had to go back to the seller and renegotiate a different purchase price. The lender then arranged for other inspections, such as an appraisal or a survey. And then finally, once approved, you would have the closing and would have signed many papers, including the term of your loan agreement. Whether you're a seasoned homeowner or a new one, you either have worked with or may work with several of these people in the home ownership process. Let's look at the roles they all play. A real estate agent is a licensed, trained professional, often involved in helping someone either buy or sell a home or a property. The mortgage broker, that is of course the middleman, the third party, who looks to match up potential borrowers applying for a mortgage loan with lenders offering mortgage loans. The appraiser is the person who conducts an evaluation of the home being purchased. The appraiser assigns an estimated value to the home and property. The home inspector reviews the interior and the exterior of the home, noting the conditions of the structure, the appliances, and other physical features. The lender, that's the bank or the savings and loan company or mortgage finance company or investment bank that receives the loan application. And if approved, the money is lent to the borrower to purchase the home. And you have the servicer, who may or may not be the lender, but it's an organization where the mortgage payments are sent and who answers the borrower's questions. Sometimes the lender will sell the mortgage loan to investment firms with packages or bundles the loan into securities and sells them again to investors. And that process can continue. And then you have the trustee, which is typically a neutral third-party person. It's not a lender or a borrower, who holds temporary title to the home and property until the lien is paid in full. This concludes part 1 of this 3-part presentation. So with this as a backdrop, let's now take a closer look at the cost of owning your own home. So please click on the link above to view part 2 of managing your mortgage.